Welcome back. We hope you enjoyed the break.
I did enjoy it in Cromel. And
you did or you did not?
I did, actually.
Okay.
Look, I'm wearing a three-piece suit, and I decided to do a quick investigation of how many individuals are wearing a tie.
Oh, my goodness.
It was 1 out of 135, so that's a very low rate, and I'm getting a little bit worried, but anyway.
I mean, it wouldn't be an actuarial society conference if there were too many ties, would it?
I think so, too.
We now move on. As you can see, our next panel is already set and ready, and we take a look at economic environment. This panel discussion will focus on current economic stresses on the African continent and their effects on insurance industry. Already on stage, please help me welcome the superstar, our facilitator for this panel, Warren Humphreys. Joining Warren, please help me welcome to the stage is also Prosper MATIASHE. Our next panelist had promised me that he was going to run on the stage like the rockstar he is, but I think we'll save it for the end. Please help me welcome to the stage Giles War. Over to you, Warren.
Okay, thanks for the welcome. Good afternoon, everyone. I think in the past few years we've very much been very aware of COVID and all the COVID impacts that have been affecting various countries across the world, including Africa, although in many cases we did maybe escape a bit in certain areas. But the big thing that also affects the countries is economics. So there's quite a few economic situations out there which are also having vast effects on the countries that have had in the past few years and are also affecting right now. And so we've been introduced by name, but in terms of just a feel for who people are. So I've got, sorry. Sorry, I've got Prosper next to me, Prosper MATIASHE. He is a qualified actuary. He's qualified through the Institute and Faculty of Actuaries. He's also an actuary in the ASZ, the Actuarial Society of Zimbabwe. He's been qualified for about 5 years. He's working at FBC Insurance in Zimbabwe, and he's very much working at data analytics, and that's that particular area, his focus area. Giles War is someone that most of us should definitely know. He's been around and he's been in many places. He's obviously qualified actuary at HASSAN. He's been on the council. He's working for Deloitte. And he spends his time on a lot of countries, and they're working on various areas, statutory actuary roles as well. For myself, I don't roam around too much, but I do work on African-related valuations within my group at Metropolitan. So mostly Southern African countries. I have worked on some Northern African countries in the past, but not too many recently. So if you see from the description of the event, we did have 2 other names on our panel, but unfortunately due to various events that we've had to unfortunately couldn't attend physically. One of them, Mr. OKYERE, has contributed to this, to some of the slides and some of the issues and questions, and I will try and run through his slides as much as I can on Ghana and specifically. All right, so I think that with that, we will just go through a few slides that have been prepared to cover the various areas and various amounts of information. And then we'll also have questions and answers after that. And of course, if you have any questions yourself in the audience or on the up, just let us know and we'll try to answer those. All right, let's move on to the slides. Okay, so we've covered that. All right, so just a quick introduction to some of the scenarios. We've got Zimbabwe, which is something that Prosper will be focusing on. We've got generally high persistent inflation, currency depreciation, and those kind of areas. Ghana actually similar in many respects, with debt restructuring being an issue that's been a factor lately. And then Giles will also be giving some general feedback across the continent on what's been happening. Okay, I think over to Prosper for just an introduction on Zimbabwe.
Thank you, Warren. So on Zim, I'll just give a bit of background, then some of the impacts that we are seeing. I've classified Zimbabwe into 4 stages. I think other people may have as many or maybe just one phase. But there will be phases of about 1980 to 1997 where the government tried to spend so much into education, into health. If you talk to senior guys, maybe some of them who are here, they will say Zimbabwe was so nice, right? But with my team at FBC Holdings, we then did a research and actually found that inflation, even back then when we could say we had glory days, inflation was already above 20%. So maybe it was an independence euphoria. I don't know if it has happened in South Africa, but I think it also happened where everything seems nice, but under all that cover, then things are happening and maybe these financial structures are not actually in right state. But by the time we get to the 1995 into 1997, there is so much strain, economic structural programs. We're starting with the IMF, and there were problems. Then we had a red phase, which I have put there, where we have land reform, we have Zimbabwe going or joining SADC in DRC. So much fiscal spending was happening there. We decided to also compensate people who participated in the liberation struggle. Back then it was 50,000 Zimbabwean dollars, probably maybe 30,000 USD back then per person, right? So what it means is if you were connected enough and you had some sort of evidence that I participated in war, you could get a free 30,000. Then we also started to have migration during that period, contested elections. There were elections prior, but there were not as much contested. And by the time we get to 2008, the exchange rate was probably 1:1 trillion, right? That's USD to Zimbabwe dollar. So here we have 1:19, I think it's still reasonable. So you then find that it was more of technical shutdown of the economy, right? Because the Zimbabwean dollar was simply rejected by the country, right? At the same time, the political stalemate then reached a case where they both realized that they needed to negotiate. So we have a government of national unity, and we adopted a multi-currency system. The most prominent currencies were the Rand and the USD, so we didn't have inflation. So there was relative stability and recovery of financial services, whether pensions, banking, you could see as much activity happening. However, that phase, what is important to remember is that there was no structural adjustment to the structure of the economy, right? It's more of just saying, let's use a currency which is strong, so maybe the prices remain stagnant, right? But are we creating employment? No. Are you reviving industry? No. So at one moment it's going to crack, right? At the same time, if we're looking at it, we are probably spending $2-3 billion ahead of whatever we were exporting. So all that cash was getting out, right? One key example was that silly products were coming from, well, our peers like Zambia, Malawi, into the country, and we're like, we all produce these things. They were also coming to look for foreign currency, because Zimbabwe became the easier target for foreign currency. Around that time, 2016, we started having cash shortages. This is USD. Why? As banks, we realized that, look, the government is saying I've paid $500 to a teacher, right? The teacher comes to an ATM and wants 500 USD. But it's me who has to import the cash from America, right? Yet the government doesn't fund the liquidity, right? So we started depleting our nostro accounts, right? So at one of these days, we just simply decided, government, if you want us to give your workers cash, bring the cash, right? Then we had technical shutdown in terms of liquidity. The government said, no, that's not a problem. We'll create a surrogate of the USD, which we call the bond note. It's 1:1, right? So they said there's somewhere in Egypt, there's where they've stored 250 million, which is covering the 250 million in the country, right? I think people trusted it, because for a year or two, we were 1:1, right? But basically to us in the financial sector, the government already was printing currency, right? The prior years from 2009 maybe to 2015, at least there was no explicit printing, right? By then, by the time we get to 2018, we were doing explicit printing, and on the parallel market already, we were then seeing 1:3 maybe, but the government still said 1:1, right? Then we had more of a political change. Then we had elections, a new finance minister came in, and he then said, look guys, we've been lying to each other. All this other money that we were saying is one-to-one is actually not one-to-one. So I'm decoupling the currencies. You can only say you have USD if it's backed by something that is in New York or another correspondent banker that we have somewhere, right? As long as it's USD local, this is now RTGS, right? So RTGS is just a system that was created by the authorities to transfer local balances, right? But it then became a currency. So 2019, that's when they formally de-dollarized, saying we are now using the Zimbabwe dollar. They fixed the currency to say it's 1:2.5. How it was calculated, it was not explained. So after that, since then, 2019 up to now, we then have had significant currency depreciation. Currently, the dollar trades at about 1:5,600 in the formal market. On the parallel market, it's 1:8,000, right? So it then shows you that in a period of about 4 or 5 years, we have lost so much value, right? I'm going to show what it does to our products. Right now, we have more of a compromise, right? So what happened is that in 2019, when they de-dollarized, the rate automatically moved from 1:100, right? So it was so apparent that people don't like this currency and they are not happy. So when COVID then came, the authorities found so much wisdom to justify that we are retaining multi-currency because there is COVID. They didn't say because our currency is struggling, right? So since then, we have some sort of a pseudo multi-currency where we have a local currency and also other currencies like the Rand and the USD. So what it does, just to show you the distortions that we have, which are maybe the basis of our challenges, is that if you look at the market, when we started, it was 1:1, right? But already in the parallel market, someone was saying it's 1:1.5. So at any time in Zimbabwe, the parallel market is usually 50% more than the formal, right? So what it does is that if I go to the RBZ or the Reserve Bank, for example, or to my bank and say, can I buy a dollar for 5,600? For some reason, I'm given the dollar, right? I'll automatically just get out of the door of the bank, then I trade the same dollar for 8,000. I come back into the bank, I would have made $2,000 Zimbabwe dollars profit, right? So at any time, you can make 50% just trading the currency. If you are a fuel importer, for example, it's very easy because you can say I'm importing fuel, right? But you don't import anything, right? So what it does is that because we call it a parallel rate premium, right? Where at any moment in time the formal is so overpriced, so you can just circulate in between formal and the parallel. So what it does is that, for example, for access banks and insurers, even if you recognize your premiums, you get them in USD. Like it's allowed to sell a product in USD or in Rand, right? You are going to recognize it at Interbank, right, which is the official, right? So if you collect a dollar, your income in GWP is 5,600. But the same day, if you have a claim, the repairer of that vehicle will charge you 1:8,000. So whichever way you want to try and be stable, it's going to be difficult. So if we were to read our financial statements, right now a combined ratio of say 150% is reasonable, right? Because there's always that distortion. What is also then happening is that every time we try to print more Zimbabwe dollar or create more money supply in Zimbabwean dollar, the exchange rate spikes again, right? So the stock of local currency then significantly reduces, right? So as you can see, we are continuously then achieving 80% of even deposits in the financial system being in foreign currency. It's debatable, of course, to say, is it proper currency or now we are already printing some cash? But you can see that we are now again being forced to dollarize, right? Recently, the authorities then introduced the gold coins, right? Where they said the government is getting so much gold, we are doing so well, so will sell you a 1 milligram of gold at this price, right? You can buy in USD or in ZWL. The funny thing is that you can buy this gold again at the official, which is 5,600, right? You can go and then mint or even melt that gold coin, right? And take it to Dubai, then you get proper currency. So there's so much arbitrage opportunity that you can also utilize. When they realize that now the stock of gold will be depleted, they then said, we have created a digital one where it just follows the gold coin price, right? So you can assume that the digital that I've given you and the physical are equal. So we're just saying basically, because the donkey resembles the cow, they are the same, right? So again, you then find that people are also saying, so is this digital currency correct? Are they introducing a new currency or not? Again, all that fear leads to more inflation. So what you will see that, just to show the impact of all these distortions that are happening, you can see that in terms of assets, for example, life insurance, right? We have, when we started, we were probably only 900 million in 2009, but during the period of relative stability, we managed to grow the assets, right? Since we have de-dollarized again, we have shrunk, maybe possibly again back to the cases where we were there in 2009. But what it means is that the value of assets held by all life offices have not increased, right? One could then argue that all the premiums that we have collected between 2009 and 2023 are actually worth zero, because you are still holding maybe the same assets that we had 10 years ago. So all this other money that circulated has been lost in that period, right? Also, if we are just looking at how many, the population has increased maybe from about 12 million to 16 million, but the same level of insurance assets, it shows that the cake is shrinking. Again, GWP, it's not much, but again, maybe with 100 million, at one moment we were as much as 270 million, right? So the economy was growing, right? People were now being able to afford insurance, but again, when we de-dollarized in 2019, again, it all shrunk. We are trying to recover, but it's because for general insurance, you find that people insure their cars in foreign currency so that they avoid things like under-insurance and so on. So there's a bit of more resistance there compared to short life side. If you look at pensions, again, almost the same story. We go up. When we de-dollarized, we have almost wiped off all the value that we had created. So I think the biggest accusation that we have been given as actuaries, at least in Zimbabwe, is that pensions don't work and we are the profession at the forefront of then just selling that mirage of saying it works, right? But when we then looked at saying, how can we make it work? A good example is to use Delta Beverages, which is the biggest alcohol and beverages manufacturer in Zimbabwe, right? So that is the measure of economic activity, of the happiness of people and everything. So as you can see, when we started in 2009, the share price was probably 10 cents, 20 cents, right? And it grew up, right? So much alcohol, they were declaring dividends, we reached $1.40, right? And for almost every pension fund and life office, other than property, this is the stock or the share that they will all buy, right? It really contributes significantly to most of our positions, right? Then you see that as we then start having de-dollarization, we struggle up to a moment where we had almost 11 cents, right? So even if as an actuary you had done a proper investment strategy to say, in Zimbabwe people buy as much alcohol to all solve their problems, at least in the short term, right? You find that still the value wouldn't have been retained, right? So maybe we could then argue we need to take positions offshore or gold, or maybe now we are even saying maybe let's buy cattle or something that is not really affected by all this that is happening. But there is very significant shortage of assets, at least in the formal market, that we can consider to place positions. We had a bit of recovery between 2019 up to 2021, basically everyone who had Zimbabwe dollar was then running to buy Delta shares. Right? So it was not necessarily that we were really performing that much. Now we are back to the same case. So what also happens is that the government, when they also see so much inflation, and shares, because they are a refuge for inflation, will perform usual, right? But they then say the stock market is the problem. So we started by removing Old Mutual from the stock exchange. We removed all the dual listed, but it's not working, right? Nowadays, they've put so much punishment. If you trade your shares, you sell within 6 months, there's about 40% capital gains tax, just to try and make sure you don't trade, right? But in doing that, the liquidity on the market is so small that the price is also significantly shrunk. Just to touch on how regulators looked at it, instead of really addressing the problem, which is the macroeconomic one, we have put so much regulation, right? For example, we have put a compensation framework which says for all the value lost during 1980 to 2008, we want to compensate, right? But as you can see, whether it's properties or stock, there's no value to use to compensate. So they've said, we'll use you, the young guys, your contributions will compensate the older guys. So you are compensating your father, basically. We have also done a program where assets that were bought before de-dollarization are segregated from those that we then accumulated after de-dollarization. It just helps to manage transfer of wealth from the older generations to the young generations. But it doesn't solve the fundamental problems of insurance. Nowadays, of course, you are allowed to make USD contributions and payouts. For example, whether it's life, it's general insurance, even pensions, you are allowed to do that, right? But the question is just that unless you are an exporter, the USD that you argue that you are making will probably be thin air very soon, like what we did in 2018, right? So we'll probably repeat the cycle which we had between 2009 and 2018. We can dollarize again, then very soon the government starts printing again, then it repeats itself. So it doesn't necessarily solve our challenges. Just to wind up the deposits in the banking system, the same behavior. We go up, then we have shrunk, right? So what it means is that we don't have as much to lend to the market. So we have 1.6 billion in terms of loans trying to support a 25 billion maybe economy, which is not actually possible. An interesting one, which I hope my colleagues here who are auditors from South Africa would understand, because we are audited by people from South Africa. IFRS 9 modeling, whether you have put so many variables, they don't make sense, right? So, for example, you can put income, you can put the industry, you can put age. Their performance will be flat. There's no correlation, there's no relationship. Why? The relationship of whether someone can pay is just basically that if you borrow it 1 million today Zimbabwean dollars, being worth maybe 2,000 US, next year I can bet you that it will be worth $5 because of exchange rate depreciation, right? So everyone is able to repay back their loans in Zimbabwean dollar, irrespective of who they are, right? But the funny thing is, you have an auditor who says, all your variables don't have a relationship. How do you expect me to have a relationship, right? So those are some of the complexities that at least as a professor would then face to say, all our assumptions, you can't back them. Because the biggest variable, at least, is the exchange risk, so to speak. Loans is almost the same. Non-monetary supervision, at least, is very helpful. The central bank tries to help, even IPEC, but at least the elephant in the room is not being solved. So I'll give Warren to then deal with Ghana.
Okay, thank you. Yeah, just to explain, with Ghana, the big thing is the domestic debt exchange program that was implemented. And I will just move forward on the slides. This is just a very brief information. What we're dealing in terms of Ghana, the stats that we have show that there's quite a lot of poverty, and essentially in low-income areas in Ghana. You can see that in terms of measuring the exposure to health insurance coverage, exposure to and food insecurity, there's a significant amount of people that are actually exposed to multidimensional poverty at this point. There's also, I think there's a trend towards also towards microinsurance as well, which, you know, with the smaller premiums, that would make sense. So I'll just run through this quickly. In terms of inflation trends, there was a massive spike in inflation in this recently. So the economy in Ghana was actually doing very well in sort of 2020, 2021. 2020, I think it did sort of 0.5%, then up to 5% in 2021. Things were going very well. And then suddenly a crisis hit where there was defaults and there was a massive inflation spike that kicked in, which you can see in the graph there in 2022. So the default that emerged in terms of the government debt meant that you've lost about 30–40% of your value on the assets, on government bond assets. And that affected insurers as well. The insurance, I think I'll just move on to here. Sorry, nope. Okay. Oh, okay. This slide is actually not a complete slide that I was hoping for. But in terms of the debt exchange program, then we had a reduction of about 30% of value. Insurers were hit, but if you look at the actual total debt distribution on that graph, I mean, commercial banks and other entities had a far higher holding. The insurance business was actually a small little sliver at the top there, very small effect, but it's obviously the extent of your percentage holdings is the key. So depending on the size of your holdings of this government debt, you either got mildly hurt or you got heavily hurt. And some insurers actually did suffer quite a serious hit. Most entities, financial entities as well, also took a lot of damage. What we saw, I'll just move back there. What we saw as well, just as a note, which we can discuss later as well, is that most institutions, a lot of insurers actually could not meet their capital requirements. They actually were underwater in terms of what was required, because in Ghana you've got your sort of risk-based capital calculation, but then you've also got a 50 million cedi underlying minimum, and that for any kind of smallish size, reasonably sized company, that's quite a large amount. And in many cases, actually, they were struggling to meet that coverage. But the good news is that the government did react to that and put a moratorium on that requirement. But it does show you the extent to which this impairment of debt actually hit, is that insurers who normally operate at a reasonable level of safety actually got down to the point where they were struggling to demonstrate that safety on the standard capital demonstration terms. So that shows the extent to which some of those elements were actually hurt. So we can cover that in the questions later on, but that's just a very brief summary of what happened in Ghana. I think the next section is for Giles.
Is this my, yes, good. And it seems to be sounding okay, so I'm actually an import. I was from the UK, obviously, but I'm also an import to this panel because I'm here to talk to you about the Angola economic crisis. So with respect to Katleko's challenge for the shortest presentation ever, bom dia. That's the end. I'm afraid I don't know anything more about Angola, and I gather bom dia really means good morning, so even that's wrong. So apologies. So I'm going to talk to you about government debt levels around the continent instead. I thought I'd start with an overall picture of the world. So the darker means the heavier debt levels are across the world, and it's a bit difficult to tell from this picture because they're so small, but actually the biggest government debt, apart from Sudan, which has very special reasons for problems, Japan is top of the tree. They have around 250% of GDP government debt, which is quite a lot if you think about it. Greece, which is also a very small dot in the bottom right-hand corner of Europe, is just below 200 last percent I knew. Italy is creeping up there. In fact, the whole of the Western world has pretty high government debt levels. Let's focus in on Africa. Which is here. So obviously it's got the dark Sudan, but high debt levels in Zambia in particular. The and I'm going to say something which will be a bit of a theme, which is every country has its reasons for problematic debt levels. It's usually a mixture of circumstance and mismanagement. So Zambia, for example, circumstance, the copper price got into difficulty. Mismanagement, well, you can guess that it's something to do with government. The current government is trying to deal with that. I'm sorry, Zimbabwe doesn't appear very high in the stakes there, but probably because they've just got rid of debt in funny ways. Mozambique is high. Angola, which is on here, is not quite so high. Ghana, you'll see, is slightly darker. Kenya is slightly darker. Congo is, which, given its oil resources, is rather sad, is quite high. So that is a picture of Africa as a whole. But that doesn't look too bad compared with the rest of the world, does it? Why then are governments running into problems? Well, the problem is that the interest rate they have to pay is a lot higher than the rest of the world. Japanese interest rates are somewhere between 0 and 2%, but probably closer to 0%. Whereas for Africa, we end up paying quite high interest rates. So if you look at the government interest payments as a proportion of their total government expenditure, which is probably the best way of testing how sustainable the government's programs are, that's where Ghana comes in quite dark. The reason why they did their debt exchange program is they're just paying too much money in interest payments. Why in their case? Well, a few economic mistakes. First of all, the previous government, obviously it's always the previous government, spent a lot of money probably trying to keep in power. They were unsuccessful, but by that stage there was huge government debt. Unfortunately, the current government can't escape blame either. They issued a big raft of Eurobonds to stabilize their debt position. Unfortunately, at a time when they hit a inflationary experience above 50%, as we see. So, of course, they had no money to pay their dollar-denominated debt. Angola, similar problems. And it's really worrying when you see that happen. You know, they're backed by oil. They're an oil currency. And oil is not a low price. So why are they in such difficulty? Well, we suspect it's to do with the previous government. Okay, Zambia is in trouble. The big question mark I would have in this picture is about Kenya. Kenya is actually in a similar position. I saw a headline a few weeks ago that the president is just off to China to see if he can borrow another $1 billion. So anyway, I think it's a risky situation. The problem with data, of course, is that often data doesn't exist, or at least it's not readily available. So you see a lot of the continent there is actually blanked. It's actually cross-hatched slightly. So we can't see how much trouble Nigeria or Egypt is in on that graph. The last data for Egypt was 2019. 2020, this is at 2020. Egypt was just teetering up, and as we know, is having its own problems providing food for its population because it was totally reliant on Ukrainian grain. So anyway, we've got some big problems across the continent. So I'm going to have a little bit more of a look at Zambia, just because I could get some data for that. Oh yeah, sorry, I can't ask for somebody to switch the slides. It's me. Okay, so Zambia started hitting problems around 2017, so I can't read the slide, you probably can, as the government fell into their debt trap. It reached its peak in 2021. A new government comes in and attempts to sort it out, but it's very difficult when you're a bit short of foreign currency because the copper price has plummeted. So they're doing their best, but it's not easy. One of the interesting, so the rule about you want to sort out your debt problems is, first of all, inflate your way out of difficulty for internal purposes. Make sure that your internal debt is fine. But also go cap in hand to the World Bank, say we're changing things, we're restructuring our economy, please give us some debt forgiveness. And the World Bank has been pretty generous in the way it's done that. But unfortunately, the game is a bit different nowadays. So this is a picture of the Zambia foreign debt by sources. Unfortunately, the largest proportion is under other, so I'm sitting here having no idea what's in that other. However, ignoring that problem, the World Bank is in the grey, so it's a significant lender, but there's also some Eurobond debt, which is the second largest. And then China, some direct from the China government, but some from the China Exim Bank, which is actually, if you put that together, the largest proportion of foreign debt provision to Zambia. And China's been a little bit more careful in renegotiating its debt. It's taken longer to renegotiate, and the terms have been rather more stringent. Reportedly, it's more willing to take collateral for their debt. The last I heard, the Sri Lankan port is in the hands of Chinese, which of course means that no income is going to Sri Lanka, it's going to China instead. There was word that something similar might be happening in Kenya with the new standard gauge railway between Mombasa and Nairobi and Mombasa port. I've seen some reports in the press denying that, so it's an open question, but there is definitely a little more hard-headedness, if not hard-heartedness, from the Chinese in debt renegotiation. So it's not quite so easy to sort out your own problems. So that is the sort of overall picture of what's happening in Zambia. Are we now going for questions? No, we've got a little bit on actuarial implications. So back to you.
Yeah, I think we can just talk to just the very quick, I'll run through this very quickly. So in terms of Ghana, we've got various implications that come through. So there's a lot of investment risk that's obviously now piling up with these new assets being under pressure. Suddenly, government bonds aren't as reliable as you'd hope they would be. And pricing, similar sort of thing. You've got with those assets and with inflation coming through, you've got a problem with your pricing. You have to adapt to the markets and what's changing. Economic assumption changes, that's a big thing. I think we've seen that in Ghana, where suddenly your interest rates and your inflation assumptions have gone up into major double digits, 20-something, 30% assumptions. So that affects your reserves. That affects, and directly affects your solvency. You know, your reserves have a massive expense component, and it's growing quickly. And that covers that expense assumption changes item 4. And as I mentioned, moratorium on regulatory compliance. Luckily, the regulator has seen that they just can't enforce the standards they would like to force on solvency at the moment. And then IFRS 17 implementation. It's something I have as a question, actually. Maybe people can give feedback on to my right here. IFRS 17 implementation-wise, I'm just thinking in terms of the effects. One of the effects, you'd hope that your reporting structure wouldn't do too much to the fundamentals of how your business operates. But one of the advantages IFRS 17 was going to give was maybe stabilize some of the earnings through CSMs, things on profitable contracts. If all these assumptions hit and all these downturns sort of increase your reserves, those reserves could start wiping out your CSMs and you get your earnings volatility starts coming back. So I'm not sure if that could be an unwanted maybe outcome of some of these shocks, actually changing your level of earnings volatility involuntarily. Yeah, so I think I'll cover that aspect.
I think so. For lessons for Zim, we need more agility from banks and insurers, just being able to respond to the market. I think especially in 2018, we were caught unawares. At least my employer had a balance sheet of say 500 million. It went down to about 100 million. Because we were not hedged, we trusted the government, we had so many government positions. Nowadays, we buy land like mad every day because we now know the impact. So hedging is a permanent feature. My argument or my own theory is that inflation is a permanent feature in Africa. Whether you're in South Africa or you're in Zimbabwe, I think you still need to hedge as much as possible. Also, business leaders need to speak a lot. Because what is happening now is that people have lost trust with us, the actuaries, the accountants, the leaders. They never lose trust with political parties. I'm also surprised with that. So we need to speak and say, this is how inflation kills pension. This is how it affects this product. This is how it affects your money, right? Currently, my father is a teacher. I was laughing to him to say, your pension contribution right now, because the government is paying them like 90% in allowances, right? And only 10% of whatever he earns in proper basic gross salary, right? So his contribution is less than $1. Dollar times 12 times 30 years still is not a good pension. It will be so small. So all those things we are not communicating to people. Products relevant to African market, both political cycles will still remain. Global investments are also needed, like offshore. Now I think Zimbabwe were allowed 15% offshore. Managed trends that are in Africa, like for example, the borrower always wins against the investor. That's a true thing there. So you need to be aware at any time. Effectiveness of implementing the lessons is, however, dependent on the extent of sovereign risk. I think we still need to solve that the decisions of the government affect all of us, right? So unless we speak out, unless we also have a way of participating in public policy, that will also not work. At least for Zim, yes, he is the son of the president, but we are happy we have an actuary who is the deputy minister now, so maybe we can influence. Thank you.
And then finally, some thoughts for the insurance industry. This is a more general thought. Okay, so government finances are being spent on debt. Who is that going to impact? Well, if the government does restructure the economy, does cut down the amount that it's spending, well, actually, government finances. Government is the biggest employer in most countries in Africa. And so if the government slims down, the economy slims down, and therefore, and the biggest, the middle class are the ones who are hit. And the middle class are the buyers of retail insurance. They're actually our customers if we're working in the insurance industry or the pensions industry. And so there will be a thinning down of the insurance markets if all the restructuring that should happen does happen. So our market size could reduce. Inflation, well, currently if we don't thin down, inflation is going to happen. Motor insurers are going to find that their cost of spare parts increases, therefore they have to tighten the premium rates, and people stop paying their insurance premiums. It's just too unaffordable, even though they need to do it. Maybe companies think they look good because inflation means that there's greater premiums coming in. But of course, the expenses have gone up, so profits are not necessarily increasing. I think the whole of Africa, or governments in Africa, particularly the ministries of finance, have looking at Ghana and thinking, ooh, can we do that too? Which has got to be very tempting. I mean, effectively, just tell your bondholders, we're just going to reduce the amount that we're paying you in coupon payments, as it went down in Ghana by half. Okay, that's a handy way of renegotiating. I think it's unlikely. I don't think the IMF will allow countries to get away with it next time. I don't think, but you never know. But it'll have to be a bit more sophisticated. The one thing that's special to Ghana that's different is that Ghana did not have a private annuity market. It's just starting to develop one, whereas Kenya, Nigeria, Zambia does have significant private annuity markets. Reducing the coupon payments for that would bankrupt every single life insurance company that's writing that business. Maybe they can be a bit more sophisticated about the way they do it. But let's wait and see. We just don't know what's going to happen. So I think we're now going to questions for you. We've got a few minutes left. Have we got slides to talk to?
Yeah, I think, do we have any questions? Yeah.
Thank you, team. We have a question from Karabo. I think she's sitting in the room as well. She says here, a number of countries have multiple currency regimes, and that apparently makes it difficult to measure inflation accurately. How do insurance companies then grapple with the fact that for the purposes of modeling and reserving?
Okay, so is that multiple currencies and inflation?
Yes.
Okay, it sounds like, Prosper, your kind of area.
Yeah, I think, so what we do, at least for my employer, we have 2 balance sheets and 2 P&Ls that we maintain. We have a foreign currency one in USD, so we do projections and assumptions for USD only, right? So, for example, in claims, we have a basket of parts that we normally use, or our service providers use, so we track that and try and measure our inflation. We have a basket of operating expenses, salaries, and so on. Like now, we do 50-50 in terms of salaries. So we can say USD, we are going to keep it at this. Then in ZW, the ZW1 is a bit more difficult because that's where you have most of your inflation. So I think what we do, we then also create our own baskets of the key expense items that we have. And also we have started then collaborating with guys like retailers, right? Because retailers, the inflation, they can see it weekly, right? By the time it filters to us, they would have already seen it, so we share also information with them. For Zim dollar, we have accepted that we are never going to be accurate. For this year, our budget was 19 billion PBT. We have already made 200 billion because of Zim, like inflation. So we are doing budgets every month. So, but for the USD one, even if you combine them, then say, so what's my ultimate balance sheet? That one you can predict well. Is the Zim dollar one, and for reporting, when you then report back for your financials, that's where you normally have your issues with the auditors, but you can also then give them evidence of the baskets.
I can't say I've seen anything around the rest of the continent in terms of multi-currency. All countries, as far as I know, are reporting in local. Nigeria does have a parallel market problem, but I think that everything is still being reported in Naira.
Okay, any other questions?
I think we'll take questions in the room, if there are any questions on the floor.
I had a few questions. So the first one is for Ghana. Obviously, the restructured bonds are not being traded currently. So when the insurers are valuing the assets that they say, we are undercapitalized, what are they using? Because if you look in the Ghana market currently, the restructured bonds are not being traded at all. If there's any trading, it's like related party trading. So how are they valuing the bonds? So that's the first question. The second one is, part of the problem with debt on the continent is depreciation of currency. And obviously, one of the solutions that the IMF and the World Bank could possibly consider would be to give, fixed exchange rates. Obviously, they are more developed because they took assets from Africa. So this might be a good way of them paying back, and they can give, fixed, rather than to continue to change. And then, my last point, a question to Giles also, is, like, if you look at Zambia, right, you have been going to Zambia for many years. If you look at Zambia as a country, yes, they have a debt problem, but the development that have gone on in the economy in terms of just infrastructure, in the country, there's been some level of, like a friction or corruption, as you call it. But I think some of these countries, for some of them, the one that I know is Zambia, the debt problem is not primarily because, money was wasted. It was probably overused, maybe. They spent more than they needed, but you can actually see the impact that, that it has, on the economy. So just your thoughts on that, how you sort of reflect on the changes the economy is, seeing, growth in the middle class and stuff like that. That would we say that, are all countries equal in terms of, corruption? Thank you.
Thanks, Danny. I may have to have my memory jogged on those three questions you asked. Okay, so let's start with the Ghana government debt, the new replacement bonds. How do you value them? They are not trading freely at all. Every month I ask, so what's the news? And there's no news. I don't know what banks are doing. Certainly insurers, most of them are planning to hold those bonds to maturity, so they're actually valuing them on a held to maturity basis. So they change the value of the bonds as a step cost at the point of exchange, and then they're now running them at book value from that point to the maturity date. As far as I know, nobody's attempting to do a market value. There just isn't one. So that's the easy one. Zambia, yes, actually, I agree with you. So my comment about Lusaka last time I visited there was, it's just full of gas stations. Every street corner has a gas station. So there has been some development. I would question whether it's been that productive, but there is some reality behind there. But there are still some genuine problems. So I can't quite say. I've missed out the middle point though. What was your question there?
I think that was the fixed exchange rates. Was it about fixed exchange rates?
What was the question then? What was the question again, Danny? So
that the IMF, part of the problem is that currency depreciation is a big part of the problem of debt in Africa, because, they're paying high interest, and on top of that, the exchange rates, over time, they always depreciate because high inflation. Shouldn't the IMF and the World Bank just give, fixed exchange rates debt?
Yeah, of course you're right in theory. It would be very nice, but then governments would really try and inflate their way out of debt then. So I'm not sure it's going to be a flyer. But you're welcome to try it with the World Bank and see what they say.
Okay, thank you. Any other questions? Okay, because I've got my own, so it's fine. I was just thinking in terms of, let's see, Prosper. I think you're president-elect of the society, right? Yeah, in Zimbabwe. Are you? I think so. In terms of this actual society's involvement in the industry with regulators, have you been able to interact with the parties like insurers, regulators on these kind of issues? We were discussing the financial issues. Is there room to sort of be in the discussion and be informative? Have you seen progress or setbacks on that sort of thing?
I think in terms of interaction with the regulators and policymakers, it has improved significantly. We've also benefited, for example, I think the insurance regulator now has a qualified actuary, and we really talk. So I think especially the professional matters, there's usually a level in which we can influence and implement, but the grand scheme of things sometimes is already decided at cabinet or at government level. So you also see that my colleague in this case is limited in terms of talking to me. So you compromise and so on. So I think it's something that we can continue to improve, but we do have some way in which we discuss with them.
So another question, I guess, for either of you as well is that given all these economic events that we're seeing, especially with inflation being a big factor, especially if it's a long-term inflation effect, are there certain assets, like asset classes, that are difficult to trade in or don't offer good value, especially in real terms? How do you get real terms? And similarly with products, I think the products that are fixed in nature and long-term in nature, there's a huge risk of low value and low value sort of coming out of that. So if we have these kind of issues and a systemic inflation built in, I guess do we need to redesign products to put a much more real inflation-linked benefit into them?
I'll start, maybe, but Zim is obviously an important thing. Well, actually, I was there in Zim when inflation started running away, and the rule was just invest in real assets. Okay, so equities. I think the company I worked with managed actually a bit of leverage, so it's 101% invested in equities, which is quite an interesting asset liability approach. So the traditional is equities or property. The advantage of property, of course, is that you can fool yourself for a really long time that the assets are worth it, because you've got compliant property valuers who will just ratchet up the property prices. I suspect resulting in a crash at some time. But maybe I can pass to you, Prosper, for further comment.
Yeah, I think that there are real assets, but we're also facing the same challenge in terms, for example, we always thought stocks are real assets, but as you can see, people who bought shares 2019, 2018, even if you look at all the GNU period, now they've lost maybe 50% now. Even properties, currently we're actually having a very big frenzy for properties, right? But they are overpriced. So one other problem may be if we then really achieve economic stability, they will reprice to the correct price. So there's also that risk of then over pricing, and we also lose money.
Okay, I think with that we've reached 0 exactly on our clock. So thanks to everyone. Thanks to Prosper, to Giles for your insights, and hopefully you've learned a lot. And yeah, thank you. Back to
Thank you so much. Another round of applause for our incredible panel discussion. Thank you, gentlemen. You're welcome to leave the stage. You know,